Past couple of weeks on the markets really seem to have been a bit of a tug of war between the bulls and the bears. Volatility growing, uncertainty growing at this stage, and not really quite certain where the market's going from here.
We were a little concerned towards the end of last year what would be happening in the second and third quarter. And I think this is actually the result of the central banks not wanting to put up rates right now when they should be, in case they do dampen any kind of growth prospects that the world economy may have. So we were always a bit concerned about what would be happening now. And I think it will continue to be like this for the next couple of months, possibly the rest of the quarter going into the third as well.
Of course, we have seen since quantitative easing was first introduced, the market's actually going out of sync with what we were seeing in the real economy. Do you think we need to see a levelling out here and a bit of a normalisation before these markets can move forward?
Well, I've got two comments on that, Stephen. The first one being that quantitative easing is exactly the kind of medicine that the central bankers have applied to the market, which actually got us into this mess in the first place. So they've got to try and adjust for that over the next couple of years. And the second part to that is the effect of that quantitative easing. When they do take their foot off the brake, what they have done is injected so much liquidity into the world economy that if they do anything to try and take some of that liquidity out, it would potentially have two detrimental effects on the economy. One would be to slow it down quite dramatically, and with the increase in interest rates, what they would have to do if inflation became a problem in the third and fourth quarters of this year, and possibly even into next year, the rate of that increase would be quite detrimental to growth prospects globally.
Well, we are going to see something give towards the end of June because the Fed in the US is going to have to decide what to do about quantitative easing when that QE2 package runs out. Well, what's your view on that? Are we going to see more quantitative easing? Are we going to see QE2 being phased out at that stage?
Well, I find it difficult to believe that they'd continue it, but it would be how they're going to end it or how they're going to be draining that liquidity out of the market. So I think then will be a particular problem, and it'll certainly be a political fight, particularly from the US. I think some of the European Union countries have been taking steps to try and normalize their debt levels, and that has been quite detrimental to what we have been seeing from the European economies. The US, possibly slightly different story, but maybe they'll dress up the remedy in a different way, and we'll have to wait and see what happens there. But it's certainly going to be a bit of a political dogfight.
So as an investor in that case, in the meantime, would you take a cautious approach? Would you remain very defensive in a market like this where we don't know what the next move is going to be?
Absolutely, and I think we must continue to maintain our defensive strategy, and that would be across the board in terms of the asset allocation. I think that's where you have to start and diversify across the asset classes. And equity, I think you will have opportunities later in the year to buy equities a little cheaper. We think they've had a lovely run up, and within your equity portfolio, I do maintain a much more cautious stance than what we did a couple of months ago.
Well, a lovely run up perhaps last year. This year, equities in South Africa in particular have done absolutely nothing. In fact, they're probably negative on the year. You've had a low weighting towards equities for some time now. Would you be maintaining that very low exposure to equities?
Definitely, at least for the remainder of this quarter and possibly well into the third quarter. I prefer to have higher weightings in other asset classes. I continue to maintain a very positive bias towards inflation-linked bonds. I certainly would look to being at the low or the short end of the yield curve in the bond market. Cash levels to be a little bit higher than normal, and no more than 50% in equities, with possibly still 5 to 10% in physical gold, and I do stress physical gold, and that's really as a currency hedge or a currency diversifier.
Mm-hmm. Just tell us about bonds and how they tie in with what we saw coming out of the Reserve Bank yesterday, where rates are still on hold, where the risk is to the upside given the inflation picture. How would you expect bonds and inflation-linked bonds to perform where we are going to see interest rates rising perhaps next year?
That's why I'd be looking at the short end of the yield curve, because if the market doesn't anticipate higher rates, what will be affected is the medium to long end of the yield curve. So longer dated bonds or medium dated bonds won't really perform all that well, and therefore my concentration would be up to 5-year bonds as a maximum in my bond portfolio. When it comes to inflation-linked bonds, as you know, it's one of my favorite asset classes, and it's something that I do believe that portfolios should have an overweight holding of inflation linkers. What's very good about inflation-linked bonds is that what will happen is if when one purchases inflation-linked bonds, you purchase it at a specific yield above whatever the ruling inflation level is, and that gets adjusted over time. So for example, if you buy an inflation-linked bond that's 200 basis points or 2% above the current or inflation level, that will be adjusted over time. So you will still be getting a real return above the official inflation rate. So it always is a good holding to have.
What sort of holding? You said you'd go overweight in ILBs. What is overweight in your portfolio on ILBs?
Well, I think in South Africa, anything's overweight because there are not too many portfolios that have sufficient inflation linkers in them. But I would go quite extreme and possibly up to 20% of a pension fund, certainly.
How about offshore diversification, given what we've seen happen to the Rand recently? Because that Rand was looking quite strong, down towards the 650s. It's weakened all the way back up to 7. Still an opportunity to diversify offshore, and what would you expect the Rand to do in the longer term?
I think the Rand will maintain its current levels and maintain its good performance relative to both the euro and the dollar. A good indication to see what the Rand would be doing would be to have a look at the Canadian dollar, certainly the Australian dollar, and even New Zealand. We're very similar economies, and we tend to move in tandem with those currencies. So I think that is a good indication of what's going to be happening. And I would maintain virtually an overweight position relative to the dollar, specifically because I believe that if one has a look at the interest rate cycle, South Africa is more likely to increase rates versus the US, and therefore the Rand should perform better than the dollar, certainly.